Welcome to my daily report market analysis videos with me, Richard Perry, market analyst at Hantec on Tuesday, the 7th of January. There's a very mixed outlook actually. If you look across Forex majors, little real decisive trend. I think you could argue that there certainly is Aussie weakness, and perhaps that is playing into the fact that we have these significant fires burning throughout Australia, possibly impacting through that. But risk appetite seems to be still negative through the commodity currencies, Aussie and Kiwi lower. Little bit more mixed when you come up to the G4 majors, where euros are slightly down, sterling slightly up, yen's a little bit mixed really. But the interesting fact is that we've seen that treasury yields rebounded yesterday into the close and are again a little bit higher today, and that's sort of playing into this equity markets rebound that we've had in the past 24 hours. We saw the S&P 500 closing not too far off its all-time highs again, so that correction in the S&P 500 hasn't really taken on. You've seen the VIX volatility, which spiked higher to 16 yesterday, just back around the 13-14 mark now. So a bit of a rebound that we've seen in risk appetite through the equity markets, and you can see that in the European or Eurozone markets, I should say. FTSE 100, yeah, basically flat on the day. FTSE is a little bit more self-contained in the fact that it still sort of plays a bit more of a risk aversion equity market play compared to certainly the DAX, which is significantly geared towards global growth. So improvement in sentiment certainly helps the DAX in that regard. But FTSE, again, also not helped by a little bit of a rebound on sterling, which tends to play as a negative correlation there. So a little bit of a mixed outlook, but generally speaking, that rebound coming through equity markets rather than anything else really. In terms of data points, we've got a few important ones actually today. You've got the Eurozone inflation numbers for December at 10 o'clock. Now, that's expected to see the headline inflation improving back to 1.3% from 1.0%, but core inflation expected to stay at 1.3%. So core and headline inflation at the same level according to December expectations. And then into the afternoon, we've got the US trade balance. US trade is expected to see the deficit improving slightly to 43.8 billion from 47.2 last time out. And then later in the afternoon, we've got the ISM non-manufacturing PMI. Now, what we saw earlier on in the week, or last week, was ISM manufacturing, which fell to 47.2. So this time out, we're expected to see the ISM non-manufacturing, where is it here, just improving slightly to 54.5. So this will be interesting to see if that does actually happen, considering the ISM manufacturing data disappointed and fell. It was expected to improve, it actually fell to a decade low. So how the non-manufacturing PMI plays out will be interesting, because that's obviously US economy, 70% consumer driven, 70% consumer driven. Okay, so it takes me on to my chart of the day, which is the DAX. Now, so I said about the S&P 500 bouncing. Well, we saw that move coming also through the DAX yesterday, but look at this. Basically, been trading in a range effectively for the past sort of 8, 9, 10 weeks on the DAX, pulling to the low of the range, but also the low of the range comes around that uptrend channel support. So a bit of a confluence level there around where we saw the market of the DAX rebounding yesterday, 12,950 effectively. Forming also a, if I zoom in here, forming also a bullish hammer candlestick, also closing that gap, which was from the previous session, that gap from 13,120, closed that gap, and again has gapped back higher again today. So I mean, you would say that there is a gap now open to the upside, so you'd argue that 13,143 is a gap that is still open, arguably needs to be filled, but I think the stability that we've got through this range, through that rebound off the low of the trading range and also the uptrend channel, is quite an encouraging move. So you'd be looking, I think, to still play into buying into weakness on this. You look at the momentum indicators, still fairly positively configured across a medium to longer term basis. RSI holding above the 40 mark consistently in recent months, picking back up above 50 in MACD lines, still above neutral. Stochastics have just slipped away, but still, generally speaking, you'd say that that would be a near-term move, and just accounting for the correction we've had off the top back from 13,425. So I think this would suggest buying into weakness on filling that gap. I think that would be an opportunity. You can see through the hourly chart, a bit more rangy really. You can see that range actually playing out fairly consistently through the oscillation of the RSI below 30, above 70 on the hourly chart, suggesting a range-bound conditions, and the near-term outlook certainly improved with the MACD lines bull crossing higher. So you've got the support around sort of 13,160, 13,143 was yesterday's high to fill that gap, but I think weakness is probably a chance to buy to retest the highs again, because at the moment it certainly looks as though that the bulls have reacted pretty positively to this geopolitical scare, or rise in tensions, I should say. So with that in mind, I wish you good luck in your trading. Click here to subscribe to our analysis videos and go to our website to sign up for our webinars.